Hi everyone, welcome to my channel. I'm Doris and I'm here to share with you about the updates for my account in the market. Today my account earned $3,671, and then I'm going to talk about US economic data and also how this data reinforced hawkish expectations from the Federal Reserve and the US stocks tumbled. First, let's take a look at my account today. Right now, the net asset of my account is $103,414.89, and just by today, I earned a PL of $4,625, which is a rise of 4.68%, and my position in total rose to $1,233.43. So as for SQQQ today, it rose 4.63%, and that's an increase of $2.52 to $56.93. And for DRV, it rose for 8.41%. That's an increase of $4.2 to $54.13. Both of my stocks showed an increase today as the market dropped. And then let's take a look at the market today. Today, Dow Jones Industrial Average dropped for 1.02%, Nasdaq dropped for 1.47%, S&P 500 dropped 1.16%. And looking at the industry heat map, it's showing red all over the place except for a few industries like oil and gas, telecom services, entertainment, aerospace, oil and gas. Most of the industries dropped because of US economic data showed a good performance, yet the Federal Reserve is keeping the interest rate high. The ADP Employment Agency reported that US private sector employment increased by 235,000 in December 22, well above market expectations of 153,000, and a sharp jump from November's data. The agency report also showed that the workers' wages rose 7.3% year-on-year in December, with those employed in the leisure and hospitality sector up to 10.1% year-on-year. The probability of a 25 basis point rate hike by the Fed in February increased slightly after the release of ADP private employment data. According to the Fed Watch tool of the Chicago Mercantile Exchange, the probability of Fed raising interest rates by 25 basis points in February to the range of 4.50% to 4.75% is 65.1%. And the probability of raising interest rates by 50 basis points is 34.9%. The probability of a cumulative 25 basis points hike by March is 9.4%. The probability of a cumulative 50 basis point hike is 60.8%. And the probability of a cumulative 75 basis point hike is 29.9%. The U.S. Department of Labor reported that initial jobless claims in the United States stood at 204,000 in the week ended December 31st, the lowest since the week of September 24th, 2022. Expected 225,000 versus 225,000 prior. The U.S. trade balance recorded a decrease of $61.5 billion in November, the smallest deficit since September 2020, expected to lose $73 billion, prior $78.2 billion. U.S. jobless claims fell 4 months low at last week, and the layoff fell 43% in December, suggesting a tight labor market that may require the Federal Reserve to continue raising interest rates, analysts said. The volatility around the year-end holiday injected some disruption to the jobless claims data. Despite a large number of layoffs in the tech sector and the interest rate-sensitive sector such as real estate and finance, initial jobless claims have remained very low amid this volatility. This means that the labor market remains really strong and the economic recession may be pushed back or even have a soft landing, yet the Federal Reserve continue to raise interest rates, which will harm the market. So that's why the industry dropped today. This comes after Wednesday's U.S. job openings and the labor mobility report from November showed that the U.S. job market remained strong and demand for labor remained hot, fueling fears that the Federal Reserve would continue to raise interest rates. But the ISM Manufacturing Index, released on the same day, shows that U.S. manufacturing was contracting after a 30-month streak of expansion, which investors saw as a positive indicator that previous rate hikes had the expected impact of cooling the economy. Meanwhile, the minutes of the Fed's December monetary policy meeting, released on Wednesday, showed that the Fed remained committed to raise interest rates for some time, and officials expressed concerns that market misread policy. Jim Caron, chief fixed income strategist at Morgan Stanley, said the market underestimated the Fed's willingness to raise interest rates aggressively in a response to the worst inflation in U.S. history. Caron said that while Fed officials have predicted interest rates to rise above 5% in 2023, traders continue to underestimate the path of future policy tightening. Barring a dramatic event, the Fed will keep interest rates at 5.25% for some time to ensure that inflation can be brought under control. Kansas City Fed President Heather George said Thursday that she has raised her forecast for interest rates, which she currently favors above 5%, and keeping it for some time. Minneapolis Fed Bank President Kashkari also said Wednesday that the Fed should continue to raise interest rates in the next few meetings until the policy rate reaches 5.4% until it is determined that inflation has peaked. Even with mounting evidence that the price pressures have passed their worst period, it is reasonable to raise rates at least in the next few meetings before being convinced that inflation has peaked. Portfolio managers at Global Investments said that the U.S. stock market suffered its worst annual performance since 2008 in 2022, and into 2023, investors are adding new wounds to old wounds as they assess the implications of each new economic data, or Fed officials' comments, and its broader implications for the future. That's all I have for you today. Thank you for listening. Don't forget to subscribe and like. See you next episode.